and welcome back to the deep dive. You know, if you've ever listened to serious traders talking about puts, calls, um, maybe implied volatility,
Oh, yeah.
it can feel pretty intimidating, right? Like this completely different language almost designed to keep people out, reserved for the Wall Street math whizzes.
Definitely feels that way sometimes.
But what if there was a kind of undisputed guide? A book that cuts through all that speculative noise.
You mean like a Bible for options?
Exactly. Something that presents options not as these crazy lottery tickets, but as, actual strategic tools for managing your investments.
Well, that's where Lawrence McMillan's book comes in. Options as a Strategic Investment. It's basically the text.
It really is considered the definitive work. So today, that's what we're diving into, McMillan's approach.
And our mission here really is to get past all that get-rich-quick stuff you always hear about options.
Right.
We want to show how McMillan teaches you to use them strategically, for income, for protection, and yeah, for making some smart calculated bets.
Okay, let's do it. Let's start right at the beginning. Before strategies, we need the basics. What is an option, fundamentally? How does McMillan break it down?
Well, he keeps it pretty simple at its core.
Right.
An option is just a contract. That's it.
Contract. Okay.
Yeah, it gives the person who buys it the right, and this is the crucial part, the right, but not the obligation.
Not the obligation. Got it.
To either buy or sell a stock at a specific price, which we call the strike price, and it has an expiration date. So on or before a certain date.
Okay, right. Not obligation feels key. Can you give us an analogy, maybe?
Yeah, the classic one is like putting a deposit down on a house.
Okay.
You pay a small fee now to lock in the purchase price for, say, 6 months. You've bought the option to buy that house. If house prices shoot up in those 6 months, great. You'd exercise your option, buy it at the lower price you locked in.
Makes sense.
But if the market crashes, or you just change your mind, you just walk away, you only lose that initial deposit, that option fee. You controlled the potential purchase without being forced to go through with it.
That makes it much clearer. You control a potential future transaction for a small upfront cost. And this whole complex world is built on just two basic types.
Fundamentally, yes. Just two. First, you've got the call option. That gives you the right to BUY the stock.
Buy. So you'd use that if you think the stock price is going up, bullish.
Exactly. Calls are for when you're bullish. Then you have the put option. That gives you the right to sell the stock at the strike price.
Okay, sell. So that's for when you're bearish, expecting the price to fall.
Precisely. Puts are your tool if you think the stock's heading down.
And that's it. Calls and puts.
That's the foundation. What's amazing, and what McMillan really details, is how all the sophisticated strategies, hundreds of them, are just clever combinations of buying or selling these basic calls and puts.
Wow, so things like spreads or collars or just mixing and matching these.
Yep. You start combining them almost immediately to shape your risk and potential reward. It's like having basic building blocks you can use to construct almost anything.
Fascinating. Okay, let's build something then. Strategy 1. Generating income. This sounds appealing. You mentioned the covered call, often called renting out your stocks.
Yeah, it's probably the most common starting point for people using options strategically, not just speculating.
So how does it work? What are the mechanics?
Okay, first, you need to actually own the underlying stock. And typically, since one option contract controls 100 shares, you need at least 100 shares. Let's say you own 100 shares of Apple.
Okay, got my Apple shares.
Now, you sell a call option against those shares. You're basically selling someone else the right to buy your Apple shares from you, but at a price that's usually a bit higher than where the stock is trading now. Let's say a higher strike price.
And why would I do that? What do I get?
You get cash immediately. The person buying the call option pays you a price for it, and that's called the premium. You collect that premium right away, up front.
Ah, instant income. But there must be a catch, a trade-off.
There is. By selling the call, you're agreeing to sell your shares if they hit that higher strike price. So you cap your potential upside gain beyond that strike price for the life of the option.
Okay, so let's walk through what happens. There are two main possibilities, right?
Exactly. Scenario 1, Apple's stock price stays flat, or maybe even goes down a bit between now and the option's expiration date.
What happens then?
The call option you sold expires worthless. Nobody wants to buy your stock at the higher strike price if they can get it cheaper on the open market.
So
you keep the premium you collected originally, and you still own your 100 shares of Apple. You've just generated extra income from your stock holding. It effectively lowers your cost basis.
Nice. Okay, scenario 2. Apple stock price goes up. It rises above the strike price of the call you sold.
Right. In this case, the person who bought the call option will exercise their right. They'll buy your shares from you at that agreed-upon strike price.
So I lose my shares.
You sell your shares, yes, but at that higher strike price you agreed to. Plus, you still keep the premium you collected initially when you sold the call.
Okay, so I made a profit up to the strike price plus the premium, but I missed out on any gains above that strike price.
That's the trade-off, precisely. You give up the potential for, huge, unlimited upside, Apple doubling overnight or something,
Right.
in exchange for generating a consistent stream of income, especially if you think the market is likely to be flat or only rise slowly.
Yeah.
It's a way to make your assets work harder for you when they're just sitting there.
It sounds like a disciplined strategy for enhancing returns on stocks you intend to hold anyway.
It's okay.
Income generation covered. Now let's flip it. What about using options for protection, for managing risk? You mentioned the protective put. McMillan calls it portfolio insurance.
Yes, and this is where options can be incredibly powerful for risk management. Think of it exactly like insurance.
How does that work mechanically?
Okay, let's say you still own those 100 shares of Apple, trading at $100. You like the company long term, but you're nervous about the next few months. Maybe there's an earnings report coming up or some big economic news.
Yeah, market uncertainty.
So you buy a put option. Remember, a put gives you the right to sell. Let's say you buy a put option that gives you the right to sell your Apple shares at $90, maybe expiring in 3 months.
So I pay a premium for this put option.
Yes, buying options costs money. You paid a premium for that protection. But now, look what happens. That $90 strike price acts like a safety net, a floor for your stock value for those 3 months.
How so?
Well, imagine the worst happens. There's a market crash or bad news for Apple, and the stock plummets down to, say, $50 a share.
Ouch.
Normally, that would be a huge loss. But because you own that put option.
I can exercise it.
Exactly. You exercise your right to sell your shares at the $90 strike price, even though the market price is only $50.
So instead of losing $50 per share, I only lose $10 per share, plus whatever I paid for the put option.
Precisely. You've dramatically limited your potential loss. You've insured your position against a disaster.
And what if the market goes up? If Apple shares go to $120?
Well, that's the outcome you hope for. In that case, your $90 put option is worthless at expiration. Why would you sell at $90 when you can sell at $120 in the market?
So it just expires.
It expires worthless. The premium you paid for it is gone. But that was just the cost of your insurance.
Like paying for car insurance. You hope you never need it.
Exactly. You pay the premium every year, hoping you don't crash your car. But you sleep better knowing you're protected if something terrible happens. The protective put is the same idea for your portfolio. It's a cost, but it protects your capital.
That makes a lot of sense. Okay, so we have income strategies like the covered call, protection strategies like the protective put, but now we get to what feels like the really advanced part. McMillan stresses understanding volatility, right? That this is the key differentiator.
Oh, absolutely. This is where McMillan really takes the discussion to the next level. He argues pretty convincingly that you can't really succeed with options long term without getting a handle on volatility. It's not just about picking stock direction.
Okay, so break it down. What kind of volatility are we talking about?
Well, McMillan makes a critical distinction between two types. First, there's historical volatility, or HV.
Historical, so looking back.
Exactly. HV is a measure of how much a stock price has actually moved around in the past. You can calculate it. It's a known fact based on historical data, like looking in the rearview mirror.
Okay, past movement. What's the other type?
The really important one for options pricing is implied volatility, or FIA.
Implied, so yes.
Kind of. It's not a historical fact. It's the market's collective expectation or prediction of how much the stock will move in the future between now and the option's expiration date.
How does that work? How is it determined?
It's essentially derived from the current option prices themselves. If options on a particular stock are expensive, it implies the market expects big price swings. If they're cheap, it implies the market expects things to be calm.
So IV is like the market's fear gauge.
That's a perfect way to put it. When uncertainty is high, maybe before a big earnings announcement or an FDA decision for a biotech stock, everyone expects a potentially large price move, up or down. So demand for options increases, prices go up, and IV rises.
And when things seem stable, IV falls and options get cheaper.
Exactly. 4V reflects the market's consensus guess about future uncertainty or potential for movement.
This totally changes the game then. It means successful options trading isn't just betting on whether a stock goes up or down.
Right. It's also about betting on whether the market's expectation of future movement, the high V, is accurate or not.
So you could buy options not just because you think the stock will go up, but because you think the market is underestimating how much it might move. You think IV is too low.
Precisely. You're buying when volatility is cheap, expecting it to increase. Maybe you think an upcoming event is going to be way more impactful than the market currently believes.
And conversely.
Conversely, you might sell options if you think IV is ridiculously high. If you think the market is way too fearful and is overpricing the potential for a big move.
So you sell expensive options, collect that high premium, betting that the actual move will be smaller than what the high IV implies.
You got it. You're essentially selling overpriced insurance, betting on relative calm when the market is predicting chaos. This strategic view of volatility is central to McMillan's philosophy. You're trading expectations as much as you're trading direction.
Okay, that adds a whole new dimension. So pulling it all together from McMillan's perspective, what are the main lessons, the core philosophy we should walk away with after diving into this huge work? Lesson 1 seems obvious. Treat options as tools, right? Not casino chips.
Absolutely paramount. McMillan hammers this home. Every options trade should have a clear strategic purpose income, hedging risk, or a well-defined, risk-limited speculative bet. It's about calculation, not reckless gambling. You need a plan.
And lesson 2 feels like flexibility. Options give you ways to potentially profit that just buying and holding stock doesn't.
Yes, yeah, huge advantage. You can structure trades to make money if the market goes up, if it goes down, or even if it just stays flat, completely sideways. Buy and hold only really works in one direction. Options give you tools for all conditions.
Then lesson 3, which you touched on with the protective put, but seems broader, risk management is everything. The book gets into complex strategies like spreads.
Yes, and that's critical. Spreads involve buying one option and selling another simultaneously. Often the primary goal isn't just profit potential, but strictly limiting potential loss.
Why limit the upside sometimes?
Because pros know that preserving capital is job number 1. Staying in the game is more important than hitting one massive home run that could also wipe you out if it goes wrong. McMillan emphasizes strategies that define your maximum risk up front.
Which leads naturally to the final lesson, maybe the most important one. This isn't easy. Lesson 4 is that it demands real education.
Oh, without a doubt. This is not a get-rich-quick reading a pamphlet kind of thing. McMillan's book is thick for a reason.
Right.
To do this properly, strategically, you have to be willing to study. You need to learn the mechanics, the strategies, and yes, the technical stuff often called the Greeks.
The Greeks. Like delta and theta.
Exactly. Delta tells you how much your options price is likely to change for every dollar change in the stock price. Theta tells you how much value your option loses each day simply due to passing time decay.
So understanding those is non-negotiable for serious strategy.
Non-negotiable. You need a solid trading plan, you need discipline, and you need to put in the work to understand these concepts. It's a serious endeavor, not a casual hobby, if you want to apply McMillan's strategic principles effectively.
That commitment really seems to be the dividing line. Options can feel complex, maybe even overwhelming at first glance, but McMillan's work shows that with dedicated learning and a strategic, risk-first mindset, they are powerful tools that are accessible for serious investors wanting to enhance their portfolio management.
I couldn't agree more. And maybe, building on that whole implied volatility discussion we had, here's a final thought for you to consider.
Okay.
When you look at any stock or investment you're interested in, don't just ask what it did historically. Look at the options market for it. What is the price of those options, the implied volatility, tell you the collective market expects that stock to do in the future?
Reading the market's expectations.
Exactly. That forward-looking gauge, that fear or complacency priced into the options, can often be one of the most valuable pieces of information out there. It tells you what the crowd is thinking, and maybe where they might be wrong.
A fascinating signal to watch indeed. Great food for thought. Until next time, invest wisely.